Imagine if you took the same amount of money and you either invest it all at once or you invest it in small increments, let's say once per month for the foreseeable future. Well, what if I would tell you that something as simple as how and when you invest could be the difference between a future balance of $125,110 versus $223,167. So I'm going to show you why I am going to stop investing like I used to in the past. I'm never investing like this ever again. So when we first get started out with investing, well, let's be honest, we really don't have a clue what we're actually doing. Now, I don't know about you, but all of the apps with all of the different graphs and all of the news and all the information that gets constantly thrown at you as a new investor, that can be overwhelming. And in fact, it gets so overwhelming that you're like, look, I only have something as small as $5. And if I put that $5 down into the stock market, how do I know if it's going to be good or bad? And what happens if I choose this path versus the other path? Which one's going to give me the greater wealth? It's too much to understand. And as new investors, oftentimes what we do is we say, well, let me go on YouTube. And then we look at what's happening in the stock market. We follow a guru who is promoting a stock and they say, this one is the next one that's going to get you rich. And we think, well, that seems to make sense. I want to get rich. I'm going to follow the guru's advice. Now, I did the same thing when I was starting out. I was chasing performance instead of actually looking at how to actually invest the right way. But that's not what this video is about today. It's not about saying I'm never investing that way, because it's easy to say, just stop following crazy advice on TikTok, YouTube, etc. This is much deeper than that. So let's say we start off with a great pile of cash and we want to do some investing. Typically, we might do some research and drop our cash into whatever investment makes the most sense to us. Now, for ultimate diversification, I like to look at exchange-traded funds. These are funds that can hold hundreds of stocks, if not thousands of stocks, all within one particular fund. And if the performance of those companies do well, the ETF does well, and you become more wealthy. But it wasn't until I learned the importance of the time value that I'm going to share with you in today's video that really made that change for me. Have a peek inside my portfolio. This is just for 2023, so we're talking January until present date. And you can see this particular account showing an overall rate of return of 16.04%. So all the money that I invested in this particular account has grown by an additional 16%. When's the last time your boss came around and gave you a 16% raise? That's the beautiful thing about starting with investments today. So let's do this calculation and why I'm never investing like I used to in the past. Let's take two examples. The very first one is we're going to look at the lump sum versus dollar cost averaging. So over the next 12 months, suppose you have $12,000 to invest in a mutual fund that trades at $100 per share. Now, of course, over those 12 months, the fund will fluctuate in price as you see here. So month 4, you can see it's dropping to $70 a share. Then you can see it raises up to $150 a share by month number 12. Now, if you decided to drop your $12,000 straight up all at once, that's what we call lump sum investing. Ultimately, that's not a bad thing. What happens is, in the hypothetical example, you could buy 120 shares at $100 each. At the end of month 12, you'd have $18,000, which is a 50% increase on your money. Nobody's arguing with that. That's a great thing. But if you chose the dollar cost average, you would drop that $12,000 in a savings account or something like that, and then invest $1,000 each month, regardless of what the share price is. Here's how many shares you'd be buying based on the price we looked at earlier. Now, at the end of this process with dollar cost averaging, you'd have 120.44 shares over the year, and your investment would be worth $18,066. So in this example, dollar cost averaging is better than lump sum investing all at once. Spread out your wealth. But that strategy can change based on market fluctuations and what's happening with the share price of whatever fund you decide to invest in. But that's not really the point yet either of why I'm not investing. I mean, again, that also is easy, lump sum versus dollar cost averaging, but it really comes down to a plan. I just needed to get on a plan of investing. And that's what I want to challenge you today with in this video. Set up the smart investing plan. And this is where it gets powerful. Now, we're going to start right here with looking at the past because we don't have a crystal ball to look into the future, but we're going to use one of my favorite funds, QQQ. This is the NASDAQ 100, top 100 companies listed in the NASDAQ index. And we're going to basically say, let's say from 1999, 12/31/99, you're about to celebrate the new millennium, up until June 30th of 2023, very long span of time. What's going to happen is we're going to have about 282 months that pass us by through that whole period. Now you have a great sum of money. You have $28,200 to invest. And what you're going to do is we're going to look at the difference between putting that $28,200 just straight up into QQQ and forgetting about it versus if we split that up and come up with a very easy plan of only $100 a month. Now that's where I think the plan is important, and I wish I would have started this. In fact, I could have started this back in 99, but I was dumb and I was chasing the high yields, the high performance, and they screwed me every single time. And here I'm left with absolutely nothing to show for it, except for most recently with my 16% improvement year to date because I got my act together in 2018. And it's a disappointment because I wish I would have invested like I am today back then. But whatever. Right here on the Portfolio Visualizer, we're going to say that we're going to invest in QQQ, 100% of our portfolio, and we're going to lump sum that $28,200. Now, if I scroll down here, look at the difference between 12/31/99 and where we are today. Just dumping that 28K straight up into the fund would be worth $125,110 today. Not too bad. In fact, it actually peaked out over here in late 2021 at $141,000. Hey, that's not bad. It just seems like a long time. But instead of doing that, the same amount of money over those 282 months of $100 a month, it paints a little bit of a different picture. And because you're on a plan, you don't have to sit here and freak out about the fact that, where the hell am I going to find $28,000 straight up to throw into a fund? But I could find probably $100 a month. That is a little bit more realistic. Don't you hate when YouTubers give you unrealistic type of investment strategies? Oh, just find yourself $10,000. I don't have $10,000, but I do have $100 a month. Let's go up here and we're going to use the same fund and the same metrics. The only difference I'm going to put here is $100. And then I'm going to say we are going to contribute a fixed amount of $100 every single month. I'm going to analyze the portfolio, and here's what I mentioned in the beginning. Look at the big difference here. Instead of that $125,000, we now end with $223,000. It's the same time period. It's ultimately the same amount of money invested. It's just the difference of having a plan. You're now taking advantage of when the stock market's doing great and when the stock market's doing absolutely piss poor. And as a result of that, you're ending up with a higher balance than the person that put it all in at once because you had a plan. And because you're not stressing out about the fact that I only have a couple more years to go and I just got to find all this money and dump it in to the account, otherwise I'm screwed. Back off a second, take a breath, and stop investing like an absolute mad person. Come up with a calm plan. In fact, the lesson of today's video, make it as boring as you absolutely can. Don't care about what the stock market's doing. I've learned that the more boring you can make your accounts, the more boring you can make this process of, here we go, another $100 a month over this period of time, the more better off you're going to be. And then, of course, if you can scale that up with job raises and, cutting down costs and things like that, maybe it's $200 a month or $500 a month. And then that way, it doesn't take so many years to get to this final balance. But the point is, if you start today and stop chasing get-rich-quick schemes, you're going to do so much better. I had to learn the hard way. I did it all stupid for many, many years. And so I'm actually talking to my former self, and I hope it inspires you as well. But if you want a little bit more about the power of investing, even just $5 a day, check out this video next. We'll see you on the next video.